Assalamualaikum warahmatullah and hello everybody. Welcome back to my channel. Today we're going to discuss another past exam question from Mfrs to Mfrs 15, revenue from contract with customer. And what we're going to discuss is question 3 from the final assessment February 2021 that is conducted in UiTM Perak. So let's start. It is question 3. Okay, question 3 has 22 marks. You are to describe the difference between contract assets and accounts receivable. So both are current assets, but they are not the same. So what is the difference? So if you look, or if you can still recall, contract asset normally arise if you have 2 or more performance obligation, and normally you satisfy one performance obligation. Okay, the entity, which is the reporting entity, satisfy a performance obligation by delivering promised good or service, but has not yet satisfied in terms of another performance obligation if there are 2, and therefore it does not yet have an unconditional right to the consideration. So that is the difference. It does not have the unconditional right to the consideration. Right? It cannot say that the revenue has been recognized completely. So what is accounts receivable? The difference between the two. Account receivable is the case where the entity has an unconditional right to receive consideration from the customer. Here is because the account receivable have been recognized since there are no more further performance obligation to be satisfied. So here all performance obligation, if there are 2 or 3, they have been satisfied, they have been delivered, they have been completed. So that is the difference between the two. One has an unconditional right, and the other does not have the unconditional right. Next, let us look at this scenario-based question of Straight Berhad, which is an information technology company that entered into a contract with Turn Berhad and Reverse Berhad. So here there are 2 companies, right? One is Turn, the other is Reverse. So there are 2 different companies here. Let's look at what happened to Turn Berhad. So you have 2 different companies, but one seller. 3rd of November 2020, the seller here is Straight Berhad, agreed to develop a customized operating system that will only be used by Turn Berhad. So it is catered and customized for this customer, Turn Berhad. The company believes that, Straight Berhad believes that a unique software will have a better security system and easier to be customized in accordance with the client's needs. So Turn Berhad agrees to that, so that their client's need can be better customized. The development of the software and the installation was completed on 26th of October 2020. So the software has been developed and the completion of the installation is on 26th of October. And then it looks like there are 2 performance obligations, but not so fast. Turn Berhad also requested that the company is to provide training, and that has been completed by 15th of November 2020. Straight Berhad charged 1.2 million. So this is actually the transaction price that are charged for the 3 items: software, installation, and training. Development, installation, and training provided, however, are considered highly interrelated, so they are not a separately distinct performance obligation. You cannot have one without the other, so it has to come together, right? So they are considered as highly interrelated. So that means that these three are one performance obligation. It is not a separate performance obligation. Although Straight Berhad had already sent a bill for full payment, Tern Berhad have not made any payment, so it gives rise to account receivable. But let us look at what is the next contract with reverse. Straight Berhad agreed to sell 10 copies of Microsoft Office software, so a software, 10 copies of it, to Reverse Berhad on 27th of December, and the company, Straight Berhad, had installed the software at Reverse Berhad premises on the same date. So on the day it was delivered, the software has been installed. All the 10 copies have been installed. Then the training will be conducted by 7th of January, which is 2021, on how to use the Microsoft Office. The total price charge was 4,000. So 4,000 is the transaction price for the installation, training, and the supply of the Microsoft Office software. The unit price for each copies of Microsoft Office is 250. So if you see here 250, and there are 10 copies of it, so the standalone selling price for the Microsoft Office software is 2,500. So that means it is not directly given, you need to do a little bit of multiplication. The standalone selling price for installation is given directly. For all 10 copies, they are 500. So this is SASP2, this would be SASP1, 10 copies times 250. And the last one is the 2000 SASP3, standalone selling price 3, which is for training 2000. Straight Berhad received full payment on 27th of December. So the payment has been received from the customer before the year end. So if you look at the year end, it is 31st of December. Right, so here the payment has been received. And for contract with Tern, if you can go reverse a little bit, right here, no payment have been made up till the year end. So you're asked to explain first the treatment of this transaction. So if you're asked to explain the treatment, you need to go and explain that in the light of the application of the 5-step revenue recognition model, the 5-step. Right? So you need to go and explain for each contract. You can do a table like what you can see on the right side here. And then you have to prepare the journal entries to record the above contract. And lastly, this is another separate question that comes together, which is the principal-agent relationship that you need to describe in recognizing the revenue. You need to describe that. Okay, let us look at first contract with customer, which is Tern Berhad. So as I said, Tern Berhad is the customized operating system. They are highly interrelated. What is the contract? Where Straight Berhad agreed to develop a customized operating system that will only be used by Tern Berhad. Where is it? Normally it's in the first few sentences. So here is in the first sentence. The word here is will be used. Will be used. The word will be used by the customer. Next. And that contract, if possible, you can also include the date. Sometimes marks are given for the date, 3rd of November 2020. Okay, that was the first one. The second one, of course, you know, to determine the performance obligation. What is the performance obligation? Since the contract or the is highly interrelated, there is only one performance obligation. Why? Because the development, installation, and training provided are considered highly interrelated. So that was the second step. The third step is to determine the transaction price. The transaction price is here 1,200. So you just need to state the transaction price, or do a little bit of a sentence construction. The transaction price for the customized operating system is 1,200. Next, we need to look at the fourth one, which is to allocate the transaction price, the TP that is to be allocated to where to? The TP will be allocated to PO. To allocate the TP to PO, performance obligation. Here there is none. Why none? Because there is only one performance obligation. There's only one. The last step is to do the recognition of revenue. So you will recognize revenue according to Mfrs 15 when or as the performance obligation is satisfied. You recognize revenue either over time, over the time where the service is being delivered, or another one is that it is recognized at a point in time, at a point of time. So here revenue of 1,002 can be recognized when? On 15 of November. Why 15 of November? Because it was completed on 15 of November. All the highly interrelated installation of the operating system, development and installation and training. Yeah, those are together. So that was recognized on 15th of November. By the time everything has been completed, since they are highly interrelated. Next, we go to the next contract with reverse. For reverse, as I said, there are 3 performance obligations because they are not highly interrelated, meaning that it is a distinct performance obligation. So Straberhard agreed to sell, what happened? To sell the 10 copies, sell and install 10 copies of Microsoft software, and also provide the training for reverse when, if you have the date, put the date on 27 of December 2020. Okay. Next, you have the second one. You are asked to determine performance obligation. So how many performance obligation? 3 performance obligation. Where do we get that? Here you have the Microsoft Office software that you supply. Second one is the installation, the blue here, installation of that software. The third one is the yellow one here, which is the training that you provide. So all 3 performance obligation, and for each performance obligation it has the its own standalone selling price, or SASP. So determine the transaction price. Transaction price is given here, 4,000. That is the transaction price, 4,000. Next, we are to ask to allocate the transaction price. You ask to allocate the transaction price. For PO1, it is the Microsoft Office software. The standalone selling price is 2,500. Where you take this 2,500, right here, 2,500, this 2,500 here. 250 times 10, 2,500, divided by 5,000 times 5,000 here is the total of the standalone selling price. The standalone selling price, the total altogether, the total is 5,000. So therefore, you will add up those total and it will come back to 5,000. So I'm putting the colors here so that you can see which one belongs to which. 2,000 here. Okay, here this one comes from here. 500 comes from here. And 2,500 is from 250 times 10. So the total of 2,005 plus 500 plus 2,000, that will make up 5,000. So the standalone selling price divided by the 5,000 here, the total standalone selling price from 3 performance obligation. Separate standalone selling price is given here separately. And then you will be doing that, repeat the same for each item. For installation, 500 over 5,000 times 4,000. 4,000 here is the transaction price. 4,000. So that 4,000, so you are finding the proportion. You don't have to make the percentage. You can directly use fraction to find the price, the allocated transaction price. So the allocated transaction price for office software, 2,000. The allocated transaction price for the second performance obligation, which is installation, 400. And the last one, performance obligation number 3, the training, is 1,006. So if you total up this, it will come back to 4,000. You can also prepare a table to do these workings. Right? Next, you are asked to recognize revenue. Not recognize revenue, you are asked to explain, right? So now you are pretending that you are the accountants and you are explaining when shall you recognize revenue. So assuming you yourself are an accountant. So revenue for the supply of software, performance obligation number 1 and performance obligation number 2. Performance obligation number 1 and performance obligation number 2 will have to be recognized together. Not together, but it has to be recognized on the same date, which is on 27th of December, recognized at a point of time when the supply and the installation of the software are completed. So meaning that the performance obligation are being satisfied. 2 performance obligation are being satisfied. Next is the third performance obligation. Third performance obligation is for the training that you provide, PO3. So for PO3, the training, revenue from training shall not be recognized for the year ended 31st December 2020. Why? Why is that so? It is because the training, if you can see here, the information given, usually the company charged 2,000 for training. Training will only be conducted by 7th of January. So next year, we are now in year 2020. The training has not been conducted. So that is why it is not been recognized, since the training has not been conducted. And thus performance obligation is only satisfied by 7 January 2021. So meaning to say that only next year that it will be recognized when we come to 2021. Next is the second part, to prepare the journal entry to record the above contract. So the first contract for the year ended 31st December 2020. These are for the current year. Right. So 15th of November, this one is account receivable. Here is, we are talking about account receivable that is turn berhad. Turn. You have just put the name because you might not know which customer. So 1002, credit sales revenue 1002. For the second one, second contract, and you will see that there are no accounts receivable because the full payment was received before the year end. If you can see here, full payment. So when full payment was received, this is a cash sale that is true for the first two performance obligation, which is to debit bank 4,000 for the total transaction price. You credit sales revenue 2004. This is actually PO1 plus PO2. PO2. You can check your working up here. This 2000 plus 400. So we can put here 2004, 2000 plus 400. PO2 400. PO1 is 2000. PO2 is again 400. So that makes up 2004. And the contract liability is for the training. Why it is not credited to the revenue? This is because as a reporting entity or as a seller, you have already taken the money from your customer. Remember, they made full payment on 27th of December. However, you have not yet provided the training to the customer to complete the performance obligation. So the money that you take from your customer is a deferred revenue, or also known as, in the terminology of Mfrs 15, that is called contract liability. So therefore, the contract liability here is actually for performance obligation 3, which is training. Okay, done. Okay, that is the journal entry, and this will appear in the SOPL, the sales revenue. Sales revenue will appear in the SOPL. The contract liability will be disclosed in the statement of financial position of Straight Berhad under the current liability. It will be under current liability because it is just due within a few months for you to complete, right? So principal agent relationship, the next one, you have to describe the principal agent relationship that is recognizing revenue. This is actually regarding other revenue issues, where it was also discussed together with the bill and wholesale, but this one is focusing on principal agent relationship. So what is principal agent relationship? Meaning to say that we are talking about the case of principal that provide performance obligation. They will provide the goods and services for a customer. However, it is the agent that arrange for the principal to provide these goods and services. Principal do not find the customer directly, but it's agent that does this on behalf of the principal. So the revenue for the agent is not the sales revenue. It is the amount that the principals give as a commission for finding the customer. This can happen a lot in the case of supermarket, where for example, you have this hypermarket that sell variety of goods from different suppliers, and they are actually taking some commission. The next one is revenue to the agent, as I said, was the commission received. So who will have to recognize the revenue? So revenue will be recognized by the principal. Yep. because they are the one that promise the performance obligation, and the goods or services that are sold are to the third party. It is not sold to the agent. Agent is the one that are selling it to the third party. Okay, that's it for this session. I hope you have benefit a lot from the session. I'll see you when I will see you. Okay, I'm signing off with that. Thank you for watching, and I'll see you next time. Assalamualaikum warahmatullah, and have a good day ahead.